Our next speaker is Daniel Lesser, and Dan is well known to this audience. Dan is a member of our chapter's board of directors and an authority on hotel feasibility and valuation. Daniel Lesser is president, CEO, and the founder of LW Hospitality Advisors. He brings more than 40 years of expertise in a wide range of hospitality, operational, counseling, valuation, advisory, and transactional services. Turning it over to you.
Thank you so much, Amanda. Really appreciate the opportunity to participate in this terrific event. So I think it's fair to say that, particularly given everything we've heard so far, that 2020 is a year that's not going to be forgotten anytime soon. The spread of the pandemic and society's reaction to the virus and what it's done to not only the global economy, but obviously the US economy as well. And the reversal of the economic devastation will likely be measured in years. When you look back over the past 40 years, there have been several severe downturns. And with the benefit of hindsight, each one of those downturns has presented terrific investment opportunities in the real estate sector. And I think it's fair to say that this downturn may very well produce a period that rivals the very best in terms of return and depth of opportunity. So narrowing it down to hotels is probably a reason I went last and don't have a whole lot of time to go over this, because it's a sector that's been devastated nearly as bad as retail, if not worse. Clearly one of the hardest hit sectors, as all forms of travel have come to a screeching halt, whether it be corporate travel, group meeting, and leisure. Although the only bright spot that exists during the recent past has been drive-to leisure, obviously fly-to leisure has been devastated. As we are already starting to see a significant amount of defaults, loan defaults in the hotel sector, and it is most likely going to continue for quite some time. I think it's important to remember that unlike other forms of commercial real estate, hotels don't have any long-term leases. Right? It's daily leasing, and pricing of guest rooms, with technology being what it is, literally changes by the nanosecond. So in an up market, that's a beautiful thing, right? If you can continuously raise your rates, right? In a down market, it'll kill you, and that's exactly what's going on now. Okay, if we could just advance the slide, that'd be great. Revenue per available room, which is essentially a calculation of occupancy times room rate. And looking back here over 30 years, it is quite interesting. September 11th and then the great financial crisis was definitely in two oh my God moments, unprecedented, greater than 20% decline in revenue per available room. We thought it was unprecedented until now. And the low point during this most recent downturn, 80% decline in revenue per available room. That is absolutely astonishing. And obviously makes the great financial crisis and September 11th look like play toys. Another interesting aspect of this slide is that we're now on the upward trajectory from rebounding from that 80% decline in revenue per available room, and we're just under 50%. And it is interesting hearing people talk about how that's good news, right? They're like elated that we're only at 50% and not at 80, right? That's interesting because that's still obviously very dramatic. Okay, if we could advance the slide. And here we have month by month statistics, occupancy, average daily rate, and then the calculation of revenue per available room. This is on the left side of the table. For the United States on the top, and then New York on the bottom. And we can clearly see that in addition to the US being severely impacted, New York has really taken it on the chin, worse than the nation as a whole. And New York is very similar to many other cities that are 24/7 urban downtown cores that obviously have been devastated by this pandemic. And then the table on the right is more of a graphic example of these numbers. And we can see that, again, the US is rebounding and New York is floundering, not really moving up at all, and still hovering around close to 80% decline in revenue per available room. These are unprecedented and quite frankly shocking metrics. Next slide, please. So if we look back at Q2, the pandemic, for all intents and purposes, call it mid-March, so 15 days into the quarter. And when we look at transactions, hotel transactions that have occurred in the United States, this is $10 million or more. In Q2 of this year, there were 6 transactions compared to the same time frame last year, 35 transactions, right? So on the far right hand of the top of the table, the number of transactions declined by over 80%. The total dollar amount of transactions over 90%. And then the average sale price per key declined by 40%. Again, these are astonishing metrics. And there were, I said earlier, 6 sales, and these are pictures of the 6 properties that sold. The big ones are the Renaissance in Baltimore, the Hutton Hotel in Nashville, and the Union Station Hotel, also in Nashville, which is interesting given that KC's commentary about the Nashville market, fundamentally, obviously, investors, particularly sophisticated hotel investors who know and understand the sector, are still bullish on Nashville. So why don't we move to the next slide, which covers Q3. And again, we see more of the same in terms of dramatic decline. This is Q3 2020 compared to Q3 2019. The dramatic decline in all the metrics, except what's interesting is average sale price per key, based on the data, actually went up 8%. So keep that in the back of your mind, because we're going to look at a couple of data points, because obviously everybody is asking, what's the decline in value? How much is it? And there's an automatic assumption that there is a decline in value, and that's not necessarily always the case. These are, again, pictures of the 12 hotels that transacted during Q3 of 2019. And just a couple of interesting notes. The Georgian Hotel in Santa Monica traded at about $750,000 per room. That's a big number. The Residence Inn Boston Cambridge just traded at just under $500,000 per room. Word on the street is that the pre-COVID, post-COVID differential is about 10 to 15% lower, but still a very healthy number on a per unit basis. The Kelly House in Edgartown, Massachusetts, which is on the island of Martha's Vineyard, just traded recently for almost $350,000 a room. Again, very interesting, highly seasonal market, sophisticated hotel-centric investors who bought that asset. And I think it clearly reflects optimism for the sector. And then finally, in New York, we've had two major transactions between the Embassy Suites, which we're going to talk a little bit more about in a minute, and then the Royalton Hotel. The Royalton's really interesting, traded for about $250,000 per room, which sounds like a really low number. And frankly, it is, particularly when you compare it to replacement cost. But the hotel hasn't made money in years. And what I find particularly interesting about it is that the seller, Highgate Hotels, who, I mean, they clearly are one of the best hotel operators out there, particularly in New York. The asset was purchased by MCR, also very sophisticated, terrific hotel owner and operator. And it'll be interesting to see, because quite frankly, if Highgate couldn't figure out how to make money, it will be very interesting to see how MCR figures it out. Okay, if we can move to the next slide. Every day we get the phone call of, okay, how much are our values down? And I will say that empirical evidence is slowly starting to bubble up. Generally speaking, the market is saying anywhere between 10 and 50%, 50. Now, that's a very wide range. The fact is that the hotel business is a neighborhood business and a street corner business, and it's very sub-market driven in terms of value declines. Not only sub-market driven, but also property specific. So now if we look at the bookends on this table, the one on the left, Sunstone sold the Renaissance Baltimore for $80 million. And that deal was reportedly supposed to go down at about $100 million in February, so pre-COVID. So there's a somewhat of an indication of a 20% decline. And then go over to the one on the right, Ashford Hospitality Trust, the publicly traded hotel company. They acquired the Embassy Suites in Manhattan in January of 19 for $195 million. and they recently walked away from the asset, and a company called Magna purchased the property for a reported amount of $115 million. So that's about a year and a half, right? And that equates to roughly a 40% decline in value. So on the left, 20, on the far right, 40. Now, what's really interesting is the middle transaction. The residence in Pentagon City in Arlington was sold a year ago by Host Hotels and Resorts, another publicly traded entity, to Blackstone for $99 million. And a year later, Amazon bought the property from Blackstone for close to $150 million. So that's really interesting. A 50% increase or $50 million in a one-year time frame is quite remarkable, particularly given what's going on. Now, you could argue that Amazon, it was a strategic purchase. It's completed acquisition of land in the Crystal City area where Amazon is obviously developing a huge campus. But the fact is that was all known when the asset was sold by Host to Blackstone just a year ago for $99 million. Interesting that $50 million was left on the table by the seller back a year ago. Okay, I'm going to move the slide. So we've heard a lot about permanent closures, and there sure have been a number of hotels, not just in New York, but throughout major urban areas in the United States that it's been announced that they are permanently closed. And while I would concede that some of these assets, clearly the improvements have reached the end of their economic lives, several of the hotels that we've heard about that have quote unquote permanently closed, I'm not so sure whether that is actually valid. So the Hilton Times Square, right? It's been announced that hotel has permanently closed. I think it's fair to say that if it does reopen as a hotel, it may very well not be a Hilton, but I think it's hard to imagine that hotel will never reopen again. I don't see an alternative use for that building, given its location, given the way it's built. I don't believe it lends itself to office or residential. So again, I do question whether in fact it's permanently closed. And then the Courtyard Herald Square is another asset it's an old bank building that was repurposed into a hotel only about, I want to say 9-10 years ago. It's a terrific asset, great location. And again, I really do wonder whether in fact it will never reopen as a hotel. Now, there are other assets like the Maxwell, which was the original W on Lexington Avenue. It's been announced that has permanently closed. I can see where that will not reopen as a hotel. So again, obviously need to take what we are hearing in the market with a grain of salt, because not everything that we hear about is necessarily true. Okay. Now, here are two assets that we haven't heard about any permanent closures, and yet I do believe that both of these buildings have reached the end of their economic life for quite some time, actually, but robust and hotel market has kept them alive up until now. It'll be interesting to see that these are big monster hotels in New York, the Hotel Pennsylvania and the Roosevelt Hotel, one-of-a-kind locations that are extremely strategic from a locational aspect and a size aspect in terms of site size. So I wouldn't be surprised if we do hear that ultimately one or both of these hotels is permanently closed and ends up being redeveloped. Next slide, please. So I'm coming up on the end here, clearly not to diminish what it has gone on and what is going on, but to some extent, we've been there, done that, and we're doing it again, right? So period of time has given me an opportunity to reflect upon my lifetime, and one of my first memories is the Cuban Missile Crisis back in 1962. And I remember watching black and white TV. This is during the days when they had 6 channels of black and white, and after the news was done at 10 o'clock, back then it was really news too. There was no more television. And sitting there listening to what was going on, and it was, oh my God, the world's going to come to an end. We're on the brink of nuclear war. This is back in 1962, right? And then you fast forward to the Arab oil embargo in the 1970s, the stock market crash in 1987, 500 points, which was, again, an oh my God moment. Today, 500 points is nothing, right? Desert Storm, September 11th. It goes on and on. The point being that we have in our lifetime experienced some dramatic downturns, and somehow we come back every time better and stronger. So if we could just go to the last slide. I think this kind of sums it up nicely. It's a quote from Winston Churchill. And clearly, commercial real estate and including hotels have been severely impacted. And the world is absolutely in uncharted territory currently, given that we just don't know when this is going to end. But what we do know, I think it's fair to say, is that, when you look back at prior economic and demand shocks, we always come back, right? And if you look at the hotel sector, somehow it's proven over and over again that the hotel sector is very resilient. And the fact is that over a long-term basis, commercial real estate, and particularly hotels, offer superior risk-adjusted yields when compared to other asset classes, particularly those that are focused on value-add opportunities. Thank you very much.
Thanks, Dan. We have a few questions for you. Let's start with, do you agree with an earlier statement that large pools of hotels will be sold by lenders at 50% discounts? That's a hell question.
They may be. Again, if you go back to my commentary about the market, speaking of somewhere between 20, 50% decline, the answer is maybe.
Okay. Here's an even easier question. How has your valuation assumptions changed regarding discount rates and cap rates, modeling rent and occupancy for hotels? I guess it's property specific, I would imagine.
It is.
Is there any type of general guideline you're using?
It is property specific, and I would say that modeling today is very much considering a new hotel, particularly hotels that have closed and then either have reopened or there's a plan to reopen. First question is, okay, what is the assumption in terms of when does the hotel reopen, right? And then there has to be another assumption in terms of when do we get past this pandemic? And I will tell you, in the early days, phone was ringing off the hook with that very question of, is it a V shape? Is it a Nike swoop? And I was amazed. I'm still amazed at some of the prognosticators out there who come out and say, yeah, by 2023, it's going to be back. And I don't know how they know, because I don't know. And this is what I do day in and day out. I've done it for 40 years. And the reality is nobody knows, right? So in terms of assumptions, you work with the best available data and information. Here's the good news. I think it's safe to say that at this point, the air is completely out of the tire. There's no downside in the hotel sector. There's only upside. And it's not a matter of if, it's when.
Great. Another question for you. In terms of the hotels that have large food and beverage or conference room group revenues, how do they replace those revenues in the short term?
That's a huge challenge. That's the bad news. It's going to take a long time for those large, big box convention group oriented hotels to come back. They'll be the last ones to come back. But quite frankly, I think that's where the smart money should be looking right now. If you look back, I want to say it was 1992, the LAX Hilton, which is almost 1,500 rooms, traded at that time for $35,000 per room. It's a lot of real estate for $35,000 per room. If big box opportunities become available and they trade for $50,000, $60,000, $70,000 a room, which is way, way below replacement cost, there's an opportunity there to have sufficient runway to absorb cash burn for a couple of years until the market does come back. So maybe your total basis ends up being $100,000 a room. That's still way below replacement cost. So I think smart money looks not only at big box hotels, but frankly at downtown 24/7 urban cores like New York. Now's the time to get into New York. It's all about your basis, right? And there are and there will be tremendous basis plays in New York in the not too distant future. And I do believe when they transact, people are going to be like, wow, that's a big number. But when we look back over 10 years, here's the deal. If you pay market today, and you underwrite for a 7 to 10 year holding period, and I underscore underwrite, doesn't mean that you necessarily have to hold it for that long. If a capital event opportunity comes up in year 3, 4, 5, you may very well take advantage of that, but you got to be prepared to hold on for 10 years. If you buy today at market and are prepared to hold for 10 years, I don't see how you can lose money.
Very true. One thing that's unique to New York City are ground leases and operating leases. What have you seen? Any issues or foreclosures, bankruptcies regarding those positions?
It's a good question, and that clearly is a challenge in New York. I think the Hilton Times Square, the announced permanent closure of that hotel is a poster child of not only a ground lease reset coming up, but several other issues, including union labor issues, which I didn't talk about at all, but that is a whole nother discussion and challenge right up there with ground leases. You know what? It boils down to economics, right? The union played hardball and in a way may have even cut their nose in spite of their face because now the hotel is permanently closed. But what also contributed to that was that there is a rent reset coming up on that property, and it's a big question mark as to what that number is going to be. And if the municipalities and the cities don't want to see blight, they're going to have to work with ground lease tenants to make it economically viable to reopen an asset. Because if they're going to play hardball also, then we're going to have closed hotels on 42nd Street in the heart of Times Square. How does that make any sense?
Doesn't. Absolutely doesn't. Thank you, Dan. I think we're out of time right now, but it was awesome presentation, and thank you so much.
Thank you. Good to see you.
You too.
Thank you both. Thank you, Dan. And thanks to everyone for joining our fall conference day 1. Looking forward to continuing tomorrow morning at 9 a.m. with day 2, a continuation of our exploration of the local market post-COVID and a focus on multifamily and development. Thank you all and have a great rest of your day.